Welcome to the second session of the working group Taxation of Token Activities. The chair is Nupur, who joins us. Nupur, would you like to give a brief introduction and background about yourself before I kick into today's Australian-focused agenda?
Hi everyone, I am Nupur, currently based out in Germany. I look into more on taxation matters. I have been working in taxation profile from some time, and I do research on the field from an interdisciplinary perspective and do write a lot of papers, speak in different places. So yeah, and that's why my passion for research is one of the reasons that I joined this committee.
We're glad to have you. Thank you. And looking forward to sharing the recording of our first session last week, which will be available. We'll notify everybody when it's available. A bit of a background and an overview to the global taxation landscape and taxpayers' dealings with all of these crypto token things. So today we're going to go through or attempt to go through 3 items. The first is actually UK focused. It's to share the Bedazzle, which is my company, Blockchain and Digital Assets Services Plus Law, submission to the UK HMRC Call for evidence on the tax treatment of DeFi staking and lending. I will go through that at a very high level, and over the coming weeks, we'll see if we can put a vote to the existing members of LawFi DAO to see if they ratify or seek to accept or approve some of the policy positions advanced in that paper. And that sort of is to set a model where a core contributor or a member of LawFi DAO can prepare a submission, and if there's not enough time to socialise it through a series of working groups or even one with LawFi DAO, then it can perhaps be ratified subsequently. The second is the Australian Treasury has released exposure draft legislation and explanatory memorandum to close a loophole, so to speak, or address some tax uncertainty that with the introduction by El Salvador in September last year of Bitcoin as a form of legal tender, that for Australian tax purposes, Bitcoin could be treated as a foreign currency, and that gives rise to various tax considerations. So this exposure draft legislation is being introduced to close that tax uncertainty or that loophole. And then finally, if we get time, it will be the Australian Board of Tax review into the tax treatment of digital asset transactions. And that's quite an involved consultation paper. There's about 12 questions. So if we don't get to it today in today's session, then hopefully next week we can delve into it. By that time, I may have also written a Bedazzle submission there, which perhaps we can share and talk through, because those submissions are due on 30th of September, as is the Treasury Bitcoin is not a foreign currency exposure draft legislation. So with that, I will just share screen. Hopefully, Nupur, you can tell me if you can see the submission now?
Yeah.
Great. Yeah. Well, I won't dwell on all of the pages, just to focus on some of the highlight sections. The HMRC's call for evidence paper made a few assumptions in setting the scope for the kind of comments that they wanted around tax treatment of DeFi staking and lending. And there's some initial observations given at Annexure A, just to say that those assumptions aren't necessarily so easily understood, even though they might be easily stated. One of those is that this reference to ownership of tokens, because the tax law, at least from an Australian perspective, it focuses on when there's been a disposal or a cancellation of a person's beneficial ownership. So their right to enjoy their property. And the UK Law Commission, a separate body in the UK, have released their consultation paper about introducing a third class of property to deal with the nuances of this global blockchain technology and the nuances that we see with the tokens that come out of those crypto token systems, as the paper coins them, no pun intended. And so the assumption that there is clear ownership for the purposes of applying the existing tax provisions, I think needs to be taken with a grain of salt. And I'm sure that the HMRC are aware of that, but it was worthy of noting, given that the law is potentially in quite a substantial state of reform, which could go into then how we seek to tax these things. And that really sets the foundation for proposing a new way of looking at our interactions with these DeFi protocols. So in the examples are given throughout, but with the Maker protocol, which is overseen by DAO governance, the Maker DAO, that is what I describe as a person to contract interaction, where a person deposits or transfers their tokens and they sit in one smart contract. They're not put at risk. And in those cases, I propose that there shouldn't be any disposal or any cancellation or destruction of, for tax purposes, of that token, because the person still has the right to withdraw their token at their discretion. Or maybe the protocol might have some other conditions around it, but if it sits in that smart contract and it's not put at risk, and this is at market risk, it still might be security risk. There may be a vulnerability in the smart contract, that shouldn't be giving rise to a taxable event. But there's another two categories where it's a person to contract to person, and that's sort of what happens in the Aave example, and person to contract, which is alchemix I usually give as an example, because you interact, well, you think that you're interacting with one protocol or set of smart contracts, but what it's actually doing is going on and using your token in other algorithmic processes, other contractual ones. And in the Aave example, it's another person having use of your tokens, and you get paid token rewards or token returns, often higher than those category 1 arrangements, to reflect that you're putting your tokens at risk. Now, the UK HMRC paper compares those. It doesn't go into detail in the way that I've described category 1, 2, and 3, but it essentially makes the generalization that when a person is involved in these DeFi staking and lending, that if it's not a tax disposal event, then perhaps could it take advantage of this securities lending type tax exemptions that find their way in many countries' tax regimes, including in the UK. And they conclude that probably a lot of the tokens on the market wouldn't meet the definition of a security, wouldn't meet the typical requirements of short-term securities lending, usually within the day before they're repaid. And so what further amendments would be needed in order to put tokens forgive me, on par with that sort of treatment, and whether it makes economic sense to do so. So I give some prompts, and I've read a few other submissions made to the HMRC where they say there should be work done, data work done with the chain analytics firms like Elliptic and Chain Analysis to understand how long are people putting their tokens into these sorts of protocols, what are the kinds of returns being experienced, how many do get subject to smart contract vulnerability attacks and lose the whole lot. And so that work needs to be done before, from a policy perspective, you can determine the tax revenue to be gained or the tax leakage from one particular treatment over the other. And this is particularly if tokens are not clearly property, as the UK Law Commission work is revealing. So I'll just stop there. Nupur, is that resonating with you, or does it raise anything that you perhaps have more questions about?
No, I was just thinking about the MakerDAO point which you raised. So mainly, can we say that it's more like a proof of stake? They are lending, they are just staking sort of thing to get the transaction fee out of it.
Yeah, and that's the other layer too, that the use of the word staking is confused, because we do it at the application level, but then there's the proof of stake blockchains, Ethereum now being one of them.
Yeah.
Excuse me. And again, the question is, when you're providing a proof of stake service, such as putting up your 32 ETH or more, is that a disposal event? In a sense, because it's put at risk. If you do a bad job, your all or part of your ETH could get slashed. And again, in that context where it's kind of like your right to play, I don't think that it's a disposal on entry. I think that it's more accurate for it to be a disposal at the time that some of your ETH is slashed.
Yeah,
What
that's
makes
what I
sense.
think. Yeah,
Yeah.
that's what I would agree. And but they receive some like in proof of stake, the person approving the transaction receives some transaction fee, but that concept is not there here. Or is that for staking also they receive some minimum fee?
Yeah. Well, the UK HMRC doesn't go into blockchain level staking.
Yeah.
I really think that they're trying to narrow the focus to that application level staking. But my submission does draw that out as well, and that there are different considerations for each. Some similar, but with the staking that you see at the application level, I take a step back and I characterize it as bootstrapping your network. You're trying to offer those incentives for people to come in, to play with and experiment with the protocol, see if they like it, and if not, then they move on, or at least they're circulating the tokens, and that gives more newsworthiness, I suppose, and chatter about the protocol, which in turn can get more eyeballs and then potentially more users. So it's very much a bootstrapping exercise. And if it doesn't work, like in the case of Terra and Luna and with the Anchor protocol staking, they didn't get enough of a network before the market was able to arbitrage and send the sister token structure into a death spiral. But if they did have grown enough network of users so that UST circulation didn't rely on those 20% anchor returns, staking returns, perhaps it could have survived. And so I give that example that maybe there is a short runway in which incentives can be provided, and that there's no tax disposal event when you enter into those sorts of arrangements, to reflect that it's early and experimental. But the UK HMRC, they gave 3 options for their preferred options for law reform, tax law reform. One of them was no gain, no loss. So there's no gain or loss on entry, and then even with the token rewards, no gain or loss. Now that they stated that at a very high level, so you could take that to mean either no gain or loss on entry or no gain or loss on the token rewards. I sort of took it to mean both, so that you could have that initial bootstrapping support. And at the early stage, you're not having the users so worried about the tax impact, because it's about, have they enjoyed the utility or not? Yeah, so we'll see whether that gets any traction. But the other option that the submission provisionally supports was basically a new division that deals with the tax treatment of DeFi staking and lending, so that it's clearer and it could leverage from existing provisions in the UK tax law, but it becomes more specific in its own division rather than having to find it in a patchwork everywhere. That also is controversial, because a number of tax practitioners think that it's more sensible to have, you know, whether there's any specific nuances for tokens in the particular CGT event that it may give rise to. But I think that you would then be too heavily crafting the nuances into the tax law on account of tokens and not other types of assets. So there's pros and cons with each. But what the submission really does is it says, there's the 3 categories at the moment, high-level categories of how these smart contract interactions can be categorized, and can you see it through that lens? And then it gives a summary of kind of the different types of things that you can do when you're staking or lending. And one of the other assumptions that the UK HMRC makes is that you will not be carrying on, or you won't be trading by interacting with a DeFi staking or lending protocol. And that isn't necessarily so clear with Australian common law. We have this concept of a person that ventures their assets into trade with a profit-making purpose can be carrying on a business, or at least the result of that transaction is taxed on revenue account rather than capital account.
Yeah.
So,
yeah, but again, the tax on capital or business or revenue account will depend upon the purpose for which the DeFi is taking. Somebody is in the business doing these things, then it may be business revenue. And suppose somebody is doing in investment capacity for DeFi, like a normal individual doing one-off transaction or few transactions, then it should be in the capital nature. This how it's
you
more
would think
like
so.
we can correlate it with the stock market transaction. No, the people do intraday trading, or say they also pull in a thing. So how that is taxable in the hand of individuals, how that is taxable in the hand of traders. So we can, I think that distinction is also relevant, rather than straightforward taxing it, saying it capital gain. Some countries are doing it. Of course, some countries said, okay, to get rid of the complexity, they are straightforward taxing it. But eventually there should be distinction, like it came through for the stock market.
Yeah, and I think it's still unclear about, this is what categories I and J try to deal with, about if you're undertaking any of the above activities with more than one class of token, and then if you're doing it in more than one blockchain, does that tip you over or tip you out of capital account treatment and put you into running a business? And those sorts of questions are really, they can be big tax dollar value, and they're quite hard still for the everyday person and the everyday tax agent to answer. But we suspect that quite a lot of taxpayers would be on revenue account if it just takes 1 or 2 DeFi protocols or 1 or 2 blockchains that a person is interacting with to be on revenue account. So does that make sense? And I think that question needs to be dealt with at the policy level, because tax agents can't, they feel that they can't make that call. And to be honest, neither do I as a tax lawyer, because every case relies on its facts and circumstances and could fall down differently. So it's not a long read. It's just a quick 13 pages, and then at the end,
who did it, kept it, but I'll do this weekend.
Apologies, my feed is breaking up, so I'm only catching every second word. Nupur?
I'm saying that you just vanished for a second. So what I was saying, that I still have to read the entire submission. I downloaded it, but still have to read it.
Yeah, no worries. Okay, so I'm going to stop sharing that one, and happy to go through in more detail once you and others have read it and have questions. I haven't heard back from the UK HMRC with any questions that they may have at the moment. So I imagine that they may just release the final report once they've considered all of the submissions. So the next
Yeah.
one that I want to share
is Australia one. Yeah. So just wanted to understand our plan of action for that so that we can plan accordingly and at least do some submission. And of course, you have much, much more knowledge from Australian front. So we can already plan how do we do it.
Yeah, well, and I'd love to test some concepts with you because I haven't put pen to paper yet on this Bitcoin as not a foreign currency paper, but I have written some notes down in my head, so to speak, about my challenges with the approach. While I'm sharing the screen, it just strikes me as odd that the exposure draft doesn't refer to any modelling work that's been done about the potential tax revenue leakage for businesses or individuals that do seek to treat Bitcoin as a foreign currency. So the key provisions are that a person could elect effectively to have a Bitcoin wallet as make a limited balance account election in relation to that wallet. So they would have AUD worth, 250K worth of Bitcoin that they could exchange and transact with without having to report the foreign currency tax gains and losses. So that 250K balance is a lot higher than the Australian 10K personal use exemption. And it's not like you can have 10K worth of Bitcoin sitting there forever. The ATO goes further and says if you want to claim that personal use asset exemption, you've pretty much just got to buy Bitcoin straight away for the purpose of using it to buy something else. You can't be holding it in a wallet and only spending your Bitcoin for personal use when the Bitcoin value is up.
Understood.
So first of all, from the individual perspective, they would get that much higher 250K threshold. And for businesses, that there's some eligibility conditions, but they can make a functional currency account election to keep their accounts in Bitcoin. Now, this would mean that, you know, if I'm a Bitcoin miner, which is the typical example, I can say I've earned 1 Bitcoin for the FY22 year, and I've spent 0.5 of a Bitcoin in my expenses, therefore 0.5 of a Bitcoin taxable income. And then at 30 June, you convert it into the Bitcoin, the Australian dollar value at the exchange rate on that day. Or you use an average rate over the year in the case of like the profit and loss amounts rather than the balance sheet amounts. And there's no discussion in the exposure draft about any calculations, the presence of Bitcoin miners, the presence of traders in Bitcoin, or the ability for Australia to attract that kind of activity here by allowing for it to be treated as a foreign currency. So does that seem right to you, that there's that sort of unfriendly attitude at the outset, which is quite protectionist, to protect Australia's ability to have its own Australian dollar used as currency and other countries issued money as foreign currency? That's the regime that it's protecting.
So, but it is only limited for Bitcoin, no? So many countries are some countries have started recognizing it as foreign currency. Now, my point of view is that okay, the definition of foreign currency especially comes, at least in Indian context, I can say that it comes from security law, exchange law. It's not specifically specified in tax law what is foreign currency. It comes from exchange law. You have to derive meaning from there. Now, it needs to be seen how the word currency, foreign currency, is defined in other law, exchange laws. Similarly, there would be some exchange laws in Australia. There also it should be defined. Now, if the foreign currency word itself is so broad, how can you say that like there will be highly mismatch between some countries saying that it is foreign currency? Now, suppose somebody in Australia deals with a person located in a country where this Bitcoin is considered as legal tender or for legal tender, let's say. And then in that case, it is a currency for them. And even in security or exchange laws, whatever in Australia, it will be covered in foreign currency. And now when you come to tax law, you say, okay, it is foreign currency. I recognize it as foreign currency. But for the purpose of taxation, I am excluding Bitcoin as a foreign currency.
Yeah, and it's so the Australian regime is perhaps unique in the sense that we also had an amendment in 2017 that introduced the definition of digital currency into our GST Act. And so it said if a thing meets these digital currency conditions, then it can have the equivalent treatment to money, which was intended to say there's no double GST exposure. So they are maintaining that. You can still use Bitcoin to pay for things and have this money treatment, but this tax, this specific tax amendment now, I believe is to specifically limit the use of the limited balance election and the functional currency account election, and neither of those things are actually mentioned in the exposure draft legislation. It just goes back to very general, for policy reasons and to eliminate tax uncertainty. This is why we've got to put this through very quickly. So it just seems strange to me that that the full tax analysis hasn't been done in the exposure draft, and we're potentially positioning ourselves as more of an unfriendly country to protect Australian dollar as money, and the US dollar as foreign currency, and whatever other typical foreign currencies are out there at the moment, and the treatments that we give from a tax perspective to allow people to hold and transact in foreign currency balances. So that it's really just saying they do not want to support those elections to be made to ease your dealings in Bitcoin as if it was a foreign currency.
Yeah, but many countries have those systems, no? Some countries, like in Asia, have recognized it as a legal tender, say, as a medium of exchange. They have recognized it as a foreign currency or say legal tender. There was a European Court of Justice case where they said that it can be recognized as medium of exchange, and hence there should be no VAT implication on this, like indirect tax implication on this. But they haven't said that it is a legal tender or it is a foreign currency. So
yeah,
that's the point, that okay, you can make it as a medium of exchange and you say, okay, there should not be GST levy or say VAT levy, which you said that in the digital currency definition in GST they have defined. So but our question is also that can that definition be imported to other forms of taxation, the digital currency definition for GST purposes that Australia have defined?
And that's what they've done in making this amendment. They are actually amending the GST definition, and then they're saying that the income tax law refers to the GST definition of digital currency. So they are seeking to connect it in that way, but it's still only limited to tax. Like you say, it will be a mismatch between the tax laws and exchange and securities laws, however they define foreign currency.
Yeah, and what does the security law, like foreign exchange law, define as? They would also define something as foreign currency for FDI purpose or or other matters. How is that defined in Australia?
I couldn't tell you specifically. It would probably be across the Corporations Act, for money laundering purposes. It could be in the Australian Money Laundering and Anti-Terrorism Financing Act. That there'd be a few different things that we need to look at. But I think that we should, and just say, hey, here's the definition, this is the context, and now that's out of step with the tax law because we haven't got a holistic policy in mind here.
Yeah. And then we have to say that then you have to, now 3 countries have recognized it as foreign currency or legal tender. And once the definition of foreign currencies in countries are defined in such a way that they say, okay, if something is acceptable as legal tender, that will be recognized as foreign currency. That is how most of the countries define foreign currency. Now, how do you make distinction? Today there are 3 countries, tomorrow there can be more countries. So you have to bring that distinction in tax law also, how to make a situation where some countries recognize it as a legal tender.
Yeah, and there's further I suppose definitional problems, because the exposure draft legislation is trying to protect that each country might issue its own CBDC. And so they say that CBDCs, and this is a shorthand, will be recognised as foreign currency because the government has issued the digital currency. But the devil will be in the detail there, because a number of the governments, first of all, I think they're exploring the Ethereum blockchain or the Bitcoin blockchain to use as the rails if they can't come to agreement on a bespoke platform. So there'll still be that public ledger component of, do they actually control the issue of their monetary supply if it relies on a consensus of nodes or validators around the world to keep that money in circulation. But the other thing being, oh, go ahead.
Yeah, but for CBDC, are countries using public blockchain? Because I have been reading a lot on CBDC, but what I understood is, yeah, they might not go for public blockchain, but yeah, I would say public blockchain doesn't make much sense there in CBDC. And even like India, what you said, India have specified, I think, yes, in the section that if it is a central government issued currency, then it will not be regarded as it will not be taxed under the scheme of taxation of virtual digital asset. So that is separate. They have clearly specified that, okay, it's foreign currency issued by government. It's a tender. It's a legal tender of the country. And every country will have to recognize it as a foreign currency. But I understand your point also, that you are saying that if they are deploying the same blockchain network and everything similarly, then why one is recognized as foreign currency and why not one? But the reason for this can be, yeah, one is centralized, they will be able to regulate. That's what they claim. That's the entire logic of CBDC, that we can control everything. So
well, they can control it for as long as the blockchain network keeps validating the transactions. But I suppose if the blockchain network fell down, they would still have a copy of the ledger, which they could replicate, on their own hard fork and manage their privately managed nodes or something like that. So there would be a contingency plan, I'm sure, but that's just one of the nuances I saw. And the other one is a number of countries are involved in multi-CBDC platforms. So you might still have the digital AUD, the digital Hong Kong dollar, the digital Singapore dollar, but actually, are they issued, or is the digital version issued by the Australian government when it's by virtue of this multi-CBDC platform, again, which any one government may not control? So the direction of which CBDCs could go is, I don't have any sense of certainty on it. And in that regard, they do propose in the exposure draft a regulation making power. And that's supposed to be a faster way of pushing amendments through, or at least clarification of law through, without having to go through the full parliamentary process, which could be good and it could be bad.
Yeah, that's but in relation to the talks of CBDC in Australia, what are the talks like? How government is considering in Australia for the CBDC?
It looks like there will be no retail CBDC in the near future, because our existing payment system infrastructure is seen to be good enough.
Okay.
But they are seeming to push through wholesale CBDC quite quickly. And
Okay.
but
Okay.
that basically means that it's a central bank to business offering, and retail mums and dads won't have access to the digital money.
Yeah. But can we draw some analogies from there if that guideline is already out or they have released something for that? For
It's
this?
more speeches. So
Okay.
there's we could refer to it, but it's still quite fluid, and it could change if a new central bank governor is appointed. It's nothing hard coded really quite yet.
Yeah.
All
So
right.
how do
Well,
you want to do this? How do you want to do this submission? Should we bring some different country example here, or you say, okay, we will pick the definition from Australia, build on those analogies, or we should be flexible to add different country examples?
I think the base submission should be Australia focused and picking up the definitions of different Australian acts. But if we had other countries willing to contribute as appendices, we could say, well, this is the perspective of Nupur from Germany, other person from Liechtenstein, depending on our network, we could have quite a bulky appendix of positions in relation to the Australian legislation. That could be one option.
Yeah, or maybe in appendix we can just say that okay, country specific differences from different countries around the world has been drawn in one appendix, and we can ourselves pick out laws in different countries which we think is maybe useful and state that.
Yeah, agree. So a bit of a scan to looking at what other countries are doing as well. I love it. All right, I have to close. We're at time, and we've got to get into the next community building session. But thank you so much as always, Nupur, and look forward to chatting to you again next week and over the emails.
Yeah. And then we'll plan how to write this next week. Yeah.
We will. We will. All right. Enjoy. See you soon.